Welcome to the Bank of Life podcast. I'm your host, James Neathery. I'm excited about today's show, even though it's not a long form episode. What we've done, we've gone back and taken clips from previously released episodes on particular topics and points. I think they're powerful. I think they're worth listening to. So thank you for listening, and hope you enjoy. If you go out into the big wide world and listen to any financial guru out there, they all tell you how terrible whole life is. And it's a world's worst place to put your money. Well, maybe they're right. But should you just take them at their word, or should you discover it for yourself? Right? I don't know. You might want to discover it for yourself. If our Nelson Nash is right, dividend-paying whole life insurance is worthy to be considered a place to pile up money, right? You might want to know. And if it is, and you pile up money, then all of a sudden you have the capital stock that's required of a bank. Before you can lend money, you have to have access to money, right? And if you want to control that banking function, you want to control and own the entity in which you pile up your money. This is so simple. And I was thinking, as I said earlier, James, what do you want to talk about? And I really want to talk about the simplicity of banking. It is so simple. You pile up money, and then you have the money moving to and from in your own control. And the fact is, you finance everything you purchase. So, James, I don't buy anything. I don't need to finance anything. Everything you do is financed, whether you pay cash and give up interest you could have earned, or you formally finance and pay someone else interest. And then you're just relying on the third-party lender if you do that. Right? If I buy something on credit, who controls that? Who controls that activity? Well, I control what I bought to a limit, right? Because the credit card company is going to give me a limit. The banker is going to give me a limit, so I can control what I purchase up to that limit. But then who controls the loan repayment? Well, I do within, very fundamental parameters. There's a minimum that's required, whatever kind of loan it is, whether it's a HELOC, personal line of credit, an installment note, automobile note, a mortgage note. They're telling you how to pay it back and when to pay it back. Now, you can pay it back sooner if you want, of course. Nobody wants to pay interest. I get it. But what happens when something goes wrong? Who controls that? What if they get mad? They don't even have to get mad. What if they change the rules of the game? All right, call a note. Right? You're not really controlling. In essence, you don't really have that much control of the banking function if you're using third-party lenders. That's my point. Okay, so if it's the oldest profession, the most profitable profession, maybe it's worthy to learn about, all right? Nelson used to say everyone should be in two businesses. Whatever it is, number one, whatever it is you do for a living. And number two, you should finance that, what you do for a living. Well, maybe I'm not in business. Maybe I'm an employee. I work somewhere and I love it and it's great and it works out. Well, everything that I purchase, all the cars, the education, the vacations, every, moderate size purchase is financed. It's either pay cash, give up interest you could have earned, or you borrow and pay interest to a third party. And that's really not complicated. That's very, very simplistic. For me to purchase something with cash, I had to have accumulated the cash somewhere. And as soon as I take it and spend it, I get the enjoyment of whatever that is I purchased. The item, maybe it's a vacation, I got the experience, but I'm never, ever, ever going to earn interest on that money again. Ever. So I gave up interest I could have otherwise earned. Or I'm going to put it on credit cards. I'm going to borrow and use a third-party lender's money to make that purchase, and then I'm going to repay that loan. There's no exceptions to that. That is so simple. All right? Okay. Now, if I get into this idea of becoming my own banker, And okay, James, I want to learn about life insurance and, potentially using dividend paying whole life insurance as a place to put money, to accumulate capital formation, right? The capital stock of a bank. And now I have access to this because life insurance is a contract, right? And it's an Einbeinstrasse, a unilateral contract. So if I have the cash value in the policy, then I have access to that cash value. If I borrow against it to make a purchase, I'm going to pay the life insurance company interest. There's no question about that. And then I'm going to control the loan repayment. It gives me the greatest amount of control that I'm aware of when it comes to the banking function. And I think it's good enough that you should consider it. Just personal encouragement. All right, but even that's simple. Going and buying life insurance, the infinite banking concept, that is very simple. Now, it gets polluted just like the fractional reserve banking system has been polluted and turned evil. Us, when we go to the bank paying interest on money that didn't exist, it's evil. It's been perverted. Right? This is the most wholesome way that I'm aware of that we can control the banking function. Like I said, life insurance is a contract. I'm buying life insurance. Yes, it comes with a death benefit. It doesn't come any other way, but there's so much value to the death benefit. So, what do? You want to practice the infinite. This is a very reason, the banking situation, the historical events. Nelson used to say, every great event in history, behind it, there's an economic cause. You cannot separate these great events from economics. Can't be done. And it's true. He's right. He was right. So what do? We have to put our money somewhere. It is okay to consider this idea of becoming your own banker. Get rid of the banking function in your life. Control the bank. Get rid of the dependency upon third-party lenders. If you could build capital strategically on purpose with intent, I'm not trying to get all the premium in year 1 or in year 2 or in year 3. I'm going to have a need for capital my whole lifetime. It may change, but it's not going to go away. And you may be the same way. So properly built, a policy that will serve you well over your lifetime. The further you go, the better it is, and the less dependent you are on the third-party lending. I don't care what interest rates are. I really don't. I can't control them anyway. I don't care what the market's going to do. Other than, my clients that are in the market, I have empathy and sympathy for them, but I can't control the market, right? Neither can they. And then inflation, oh my gosh, I can't control that, neither can you. Nobody wants to talk about, the Ukraine situation and wars, and what that does to cause inflation, but I don't want to be political. But the empire is not going to quit. They're not going to quit manipulating the money supply. They're not going to quit expanding the empire and causing inflation and causing taxation. And whenever you can practice the infinite banking concept, the systematic accumulation of capital formation, consistent over time with the long-term view, your whole life, your children's life. Is it okay to talk about a 50-year timeline? Well, not for me. I'm not going to be here in 50 years, and most of you probably won't either. But your children may be, and your grandchildren may be. And if you don't do something, who will? Are you going to let these people that run the banking system, control what you do? Are you going to let Wall Street control the outcome of your retirement and your future? No, there's a better way, right? And it is to practice the infinite banking concept. So, Becoming Your Own Banker, Nelson Nash's first book. His second book, Building Your Warehouse of Wealth. A third book, How Privatized Banking Really Works. Dr. Robert Murphy and Carlos Laura. And then a 6.5-hour DVD that's available at the Nelson Nash Institute, or I think it's available on our website, bankingwithlife.com. At least at the Nelson Nash Institute, you have access to, you have digital access, to stream the 6.5-hour series presentation by R. Nelson Nash himself. Okay, so I'm going to wrap this up. Guarantees by the life insurance company. are backed up by their claims paying ability. The secondary guarantee is a guarantee association. They don't have any money. They have the ability to tax, but they force the other legal reserve life insurance companies, if a company became liquidated, if a life insurance company became liquidated through the receivership process of the state, that liquidation is, the way that occurs is other legal reserve life insurance companies doing business in that state have to step in and take over those guarantees. It doesn't exist anywhere else. So there's primary guarantees by the issuing company, secondary guarantees by the state association, and I don't know what's safer or stronger comparatively in the big wide world. I do want to say that Executive Life out of California collapsed, an A-rated company, collapsed in, I believe, 1980. And last year, and I've said it before, I was at a life insurance event, a big Fortune, just a huge life insurance company. And one of the officers was explaining how they had just made their last payment to make Executive Life policyholders whole. And this was 2022, 42 years later. Okay. And then personally, I was not a part of that. I was not even, I was licensed permanently in 1991. That happened in 1980. I did experience a Mid-Continent Life out of Oklahoma City, A+ rated company. They really wanted to be a buy term and invest the difference company, right? So they had some blending type products, beautiful products. Undercapitalized, owned by Florida Progress, A+ rated company. State shows up and says, hey, you have 6 months to recapitalize. And so they go to their parent company, Mid-Continent Life, goes to Florida Progress, right? And says, hey, we got to raise capital. Well, Florida Progress never wanted to be in the life insurance business anyway. So they said no. And then they were liquidated. Mid-Continent Life was liquidated by other legal reserve life insurance companies. So there's an element of safety that I wanted to bring forward. The PUA gives you early liquidity. Well, and let me back up a little bit. So, I just had a birthday one more time around the sun. So when I pay a PUA premium, just forthrightly, not from the dividend, that charge is going to be on there, whatever it is, 6 to 15%, 6, 7, 8, 9, or 10%, whatever. But the net is going to buy death benefit, and it's going to be a factor of the premium. So if I pay, let's say, $1,000 to the PUA, at my age, I might buy 1.5 times in death benefit. So I paid $1,000 in premium to the paid up additions rider, and that paid up addition amount could be $1,500. I paid $1,000, 1.5, $1,500 in additional paid up death benefit, or it could be 2. Right, your age dictates that, and of course the company and the policy structure. Not the policy structure, but the construct of the paid up additions rider by the company. Consequently, if a young person, age 20, paid $1,000 in PUA premium, they might purchase that $1,000 may purchase $3,000 in paid up additions. All right, we're still talking about life insurance. So that paid up additions amount varies by your age and company. Okay. But, and let me say, when the dividend is paid to the PUA, there's typically no charge on that dividend to purchase the paid up additional riders. A side note, but what does it do? What does the paid up additions do beyond buying additional death benefit that I do not owe a future premium for? Well, it net of the charge, there's an equivalent cash value increase. So if I pay $1,000 in PUA premium, paid up additions premium, and the company charges me 6% on the PUA premium, then $9,400 or $940 is going to increase the cash value. So it gives you liquidity. And it gives you early liquidity in a whole life policy because generally there is no or very little liquidity, cash value, in a whole life policy. And that doesn't mean the agent got paid all of that money. What actually, in fact, happens is when a life insurance policy is designed by the company, the majority of the cost, and it does cost a life insurance company to put policies in force, all of that cost is weighted to the first 2 years. And then as another side note, hence Universal Life comes out to unbundle that, to separate the cost of the death benefit and the cash accumulation component. You cannot do that in whole life. You cannot separate the components of cash value from the death benefit. As much as you would like to, the termites, as much as the insurance gurus would like to, can't be done. Okay. So the paid up additions rider gives you early cash value. There's very little cash value or liquidity in a typical, straightforward whole life insurance policy because the cost is weighted up front to a policy. So the PUA was the paid up additions rider was originally created, my understanding, by the life insurance companies as a place to put a dividend. It's been around a long time, right? So the dividend's paid. If a company is financially positive in that year, if their financial experience was a plus in that given year, the dividend is paid, right, from the financial experience of the company. It's a non-guaranteed component of the policy. And the PUA, the paid up additions rider, was built as a place to have the dividend paid into. There are other dividend elections that the owner can choose, and we'll go into that in a later video. But originally, the PUA was created as a place to receive the dividend. And it was, I think I said previously in videos in the 70s, it was actually in the early 90s whenever companies began developing a flexible or dynamic PUA, paid up additions rider, that allows the owner to pay additional premium dollars above the dividend into the paid up additions rider. And then, excuse me, here, this is 2023. Those PUA riders have developed across the industry, with each insurance company, creating their own, with their own limitations, their own cost, and their own flexibility. And there are many variations, like I said earlier, of the paid up additions rider. I'm speaking, initially on a paid up additions rider as a pure paid up additions rider, not a blended paid up additions rider, where some of the companies, a lot of them, have blended a term component with the PUA rider into the PUA, and then there's a term component in that rider. They're called blended PUAs, and each company has their own, and they're a little bit different. We'll talk about those a little bit later. So there are different names, and then every company may have more than one. I think most of them do. But then there are different iterations. The PUA rider that I purchased from a company 10 years ago may not be available on new policies if I purchase a policy today. The PUA riders, just like products, they change. The companies change their products. Now, once a policy's in force, the company can't change anything about that. So if I have a PUA rider from a policy 20 years ago, and I do, they can't change that, right? It is what it is at delivery, and they can't go back and change the contract because a life insurance policy is a contract, and then the PUA rider and every other rider is also part of that contract. But my point is, today's PUA rider may not be the same as a PUA rider of 5 years ago or 10 years ago. Okay. And then, I've kind of covered the costs. They're all over the board. You can see them. And then, and I also want to bring this out, that the dividend is the dividend. The companies declare dividend if they've had a positive financial experience in a given year. The dividend's not guaranteed. When the dividend is paid into the PUA rider, that action alone causes future dividends to go up. The most important influence on a policy design is you, your family, your future. That cannot be left. I mean, that's the starting point. So any time and every time you focus or a focus is put on a particular characteristic of life insurance, we go down the road or continue down the road of flawed thinking. We continue down the road of violating Nelson's 4 fundamentals. And I've talked many times on that. If we, as simple as it is, as trite as it may sound, if you put the fundamentals that Nelson laid out, it was 4 fundamentals originally, then he added the 5th. Number 1, think long range. Number 2, don't be afraid to capitalize. Number 3, don't steal the peas. Number 4, don't be dependent upon the bank. Right, third-party lenders. And then he added number 5, rethink your thinking, because that is where the problem is, between our ears. So if we look and we try to focus on a singular characteristic, I want a little death benefit, I want a lot of death benefit, I want a particular rate of return, I want a particular ratio between the PUA and the base premium. If we focus on any singular characteristic of a life insurance policy and the construct of it, in my opinion, we're making a mistake. That's not the starting point. The starting point should be an educated consumer and an educated agent or advisor, right? And then your particular situation, your particular circumstances, what you want to do in the future, what you might think you can do in the future, what are your God-given abilities and talents? How have you been? You know, it's like if you've created a bunch of debt and you think buying big old life insurance policies, paying a big old premium, you know, the BOLA, big old life insurance premium, and then you collateralize all of that to get out of debt. The odds are that's not the problem. The problem is maybe in your thinking and your actions, right? Lack of discipline of getting out of debt. Okay. And I'm just saying that because, you know, getting out of debt and taking over credit card debt is a big marketing thing now that's like, oh, this is what you can do with life insurance. That's one thing that you can do with life insurance, but I digress. Anytime we focus on a singular characteristic or boil down the power of a policy into one particular characteristic, you know, we're going off into flawed thinking. We're violating Nelson's 4 fundamentals and this 5th one that was added, and we're just continuing that. And it may not be to your best interest. I get it. The real estate investor needs all the money today. Heck, we all need all the capital today, right? I get it. We all need all the capital today. I get it. It's still short-term thinking. You're still going to need capital in the future. I'm going to need capital in the future. Oh, wait, I'm going to become my own banker at the you and me level. I'm going to control that banking function. And then if we get into, and I'm not in this particular episode, get into an even distribution of age classes, if I want to lay the foundation for my family and future generations, should I focus on year 1 or year 2? No. Should I focus on year 5, 6, or 7? No. I want to focus. It's a whole life policy on my life. Well, the future is unknown. It's God's business when I graduate and when you graduate. You don't even know. I don't know, and I don't want to know. But I want a policy to serve me my whole life, right? I'm going to need capital if I just want to give it away at age 99. And you're going to be no different. So what you use the capital for may be different, but you're still going to have a need and a desire for capital, in my opinion. But I could be wrong. Okay, so the industries have changed, right? And being new to IBC, it's very easy to focus on the cash values, right? Well, that occurs, the early cash values in the PUA. The PUA is a very important component. So what do we do, James? Well, know your product, know the people that you're working with, and they should know the infinite banking concept beyond social media marketing. You know, they should understand life insurance. They should maybe understand Nelson's work of becoming your own banker, right? That's what we're doing. We're controlling the banking function, right? It's not just a financial gimmick to put a life insurance policy in the middle of all those premiums and all of those loans. So the things that you're doing anyway, purchasing cars, purchasing real estate, yeah, you should stick a life insurance policy in there, but you should understand what you can and can't do with the PUA. You should practice the 4 fundamentals, and you should think long term, right? Number 1, think long term. Okay. And really, I believe that that is the solution, is for you to know and be aware. Knowledge is power, and action added to knowledge is almost nirvana whenever your action is centered on your God-given abilities and talents. So how do you do that, James? Well, number one, I think you ought to be right with the universe and the creator. But when it comes to the infinite banking concept, you should know what Nelson's work is and why it matters to you, becoming your own banker. First book. Building Your Warehouse of Wealth, his second book. And then there are other books, none of which improve, in my opinion, Nelson's work. And then he goes on, I know that it's inefficient to close a policy, but it would be a relief to me to drop one. Would you help me improve my situation? And I'm inclined to say yes. I believe I can help everyone. I mean, I'm just that egotistical or whatever. I believe that I can better everyone's position. These policies have made me realize that maybe I'm just not entrepreneurial enough to practice IBC, which I even hate that the young man makes that statement. So you do not have to be an entrepreneur to practice the infinite banking concept. The infinite banking concept is who controls the banking function in your life? Who controls banking as it relates to you and your family? You don't have to be in business. You don't have to be an entrepreneur. You've got a family. Oh my gosh, 4 young children. I can't imagine the need of capital in your family, right? Start there. I mean, you don't have to be entrepreneurial. I just hate that you feel that you're not entrepreneurial enough to practice IBC, when in fact, you do not have to be an entrepreneur to practice IBC. I mean, the more entrepreneurial you are, the more opportunity you have to control more of a banking function, potentially. I'll keep reading. Okay. I don't know what to do with the cash value. And that's kind of a painful statement to read as well. It's like, you don't have to do anything. The cash value is going to go up every day. While we're talking right now, your cash value is going up. And it goes up 24 hours a day, 7 days a week, even on Sundays when the markets are closed. And I know that, there's trading that goes on around the world, but you don't. Okay? You don't have to do anything. But your wealth, your money must reside somewhere. This is a great place, potentially, for your money to reside. You're not going to improve your policy by the mere fact of borrowing against the cash values. Okay, because when you do that, the insurance company is going to charge you an interest rate, and rightly so. I'm just pointing out that the fact, just because you borrow against the cash value and repay that loan does not improve your policy. It's the idea of putting additional quote unquote interest into a policy on a loan repayment that accelerates because you're paying more premium. Page 58 and becoming your own banker. Okay. I have one loan that I used to pay off a car note. Perfect. You're married, your young children. I see 4 or 5 cars in your future. Now, I don't know how old your children are right here. Okay. I don't know what to do with the cash value. That's a solid, painful statement to read. You don't have to do anything. Opportunities appear. It becomes apparent if you're searching for how to put your capital to work. It's like, take a deep breath. Just pay a premium, but don't bite off more premium than you can chew. I get that. Watch it grow. The opportunities will come with 4 children. Man, I see potential dental, orthodontics, education, vacations. There's lots of things that you can do with your capital. It doesn't always have to be, cryptocurrency or, Bitcoin, gold. And so I'm just saying you're financing an awful lot of things right now with a family of 4 young children. Okay. Let's see. I have heard that you can never have too much money in the bank. I agree. You cannot have too much money in the bank. But if you have to trade your soul to get the income, is that worth it? I don't know. Okay. but I have to keep contributing or paying a premium, and that has become exhausting. Yes, policies are designed for you to pay a premium. They are designed to receive premium. Unless you have a 10 pay, a 20 pay, or you've reduced, paid up, you've done a premium offset, you've made the policy values pay its own premium from some point forward. Other than that, these policies are absolutely designed for a premium to be paid, period. Now, on a proper design of a policy, you can create a 7 pay, a 10 pay, a 15 pay, a 20 pay, 25 pay, a 30 pay, or paid to 100, right? So I know that in the infinite banking footprint, there's a lot of opinions out there. It's about design that, you spend too much time in design, you get into the weeds and all kind. No, design is important. All right. And the higher base premium you pay, the better off you'll be in the long term. My opinion. Okay. But you still have to have a PUA and you have to have the ability to pay a premium, right? You don't want to build a great big policy, overbuild a policy. I mean, what good does that do? Nothing, because now you're in a situation, this young man is in a situation where I don't know what to do. I can't keep them all, right? And so you don't want to be there. Okay. So it's okay to start slow and build methodically on purpose with intent. Okay. Which is my preferred method.
Thank you for joining us on the Banking with Life podcast. If you're watching on YouTube, make sure to like and subscribe and click on that little notification bell. Otherwise, join us on Apple Podcasts and Stitcher for weekly content.